In Chapter 9 study guide, I'm going to start with short-term notes payable. This is where you owe money. It's due in less than 1 year, but it's a note because it has an interest rate attached to it and a specified maturity date for the amount due. Um, so this first problem is just you bought merchandise on account, and then on April 2nd, you decided that you're not going to be able to pay that $58,400. You don't have enough cash, and so you come into an agreement with um, your supplier that you'll put a down payment down of $13,400 and then finance the remaining $45,000 in a 90-day 9.5% note. So it's a debit to accounts payable to close out that account payable, credit to cash for the down payment, and then a credit to notes payable. And then this is just another transaction where they borrowed $150,000 by signing a $150,000 note to be paid back in 90 days at 8% interest. And then on July 1st, pay the amount due on the note to Cedar at maturity. They owed $45,000. So it's a debit to $45,000. It's a credit to cash for $46,069. And the difference between those two is that is the interest expense. And so you calculate the interest for the money that they owed at that 9.5% interest. You calculate that by taking the principal times the rate times the time. And the time is expressed in 1 year. So if it was 1 year's worth of interest, this would just be one. But since it's only 90 days, it's 90 over 360. So the interest that we incurred on the $45,000 of money that we owed was $1,069. Add that to the notes payable, and it's a credit to cash for $46,069. And then on August 30th, paid the amount due on the note to Northern Bank at maturity. So same concept. They owed $150,000. It was at 8% interest, 90 over 360 days. So 150,000 times 0.08 times 90 over 360 is 3,000. So debit to interest expense of 3,000, debit to notes payable of 150,000, and a credit to cash of 153. Then they borrowed some more money from a credit union, $80,000, 60-day, 7.8% interest. So that's just a debit to cash, credit to notes payable. And then this one is a little bit different because the year ends with some interest accrued. And so we need to account for the amount of interest that we incurred during the year 2024. But since we're not paying till 2025, we need to do an adjusting entry. And so we're adjusting for 41 days. So it's the principal, 80,000 times 0.078 times 41 divided by 360, which is November 20th to December 31st. So that is a debit to interest expense for 7-Eleven and a credit to interest payable for 7-Eleven. And then pay the amount due. So remember, we owed $80,000. We did an adjusting entry for the amount of interest in 2024. Now we're accounting for the interest here of the remaining 19 days in 2025. So debit to 80,000, or excuse me, interest equals principal, 80,000 times rate, 0.078 times 19 divided by 360. So interest expense is 329. Debit the interest payable to close out the money that we owed on that interest. Close out the notes payable by debiting it, and then credit to cash for all three of those combined. So that's short-term notes payable. Moving on to warranty expense and liability estimation. This is what do we do about the warranty on our sales. So we know that our customers are going to return products, they're going to need repair, they're going to need replacements. And so because we know that, and because it's a significant amount of our revenue, we need to expense it during the period in which we make the sale. And so we have to use our best estimate as to how much of that warranty is going to get used and then apply it to that month's sales. So this one right here is just selling toasters. So it's a debit to cash, credit to sales, debit to COGS, credit to merchandise inventory. Nothing new here. That's just from chapter 4. This right here is where we work with the warranty expense. And so um, we owe at this point $7,600, and the warranty cost is 7% of sales. So 7,600 times 7% is 532. So we have to expense for 532, and then we need to credit estimated warranty liability, which is basically a pot that we put the money into, and then when someone exercises their warranty, whether they ask for a return or they ask for a repair, we pull that money out of the estimated warranty liability account by debiting it. So once again, I got that number by taking 7% of my September sales, which is 7,600. And then replace 6 toasters. So 6 customers sent their toasters back in. We sent them back a new toaster. So that's credit to merchandise inventory for 6 times 22, 22 being the cost of goods sold. And then once again, like I explained before, we debit estimated warranty liability, meaning we pull that money out of that pool of money we put in. Then in November, we sold 230 toasters for $21,850 cash. So once again, that's the transaction there. We replaced some more toasters. Debit to estimated warranty liability, credit to merchandise inventory. 18 times 22 is 396. And then we recorded our estimated warranty expense for November and December. We had one sale of $21,850. 21,850 times that 7% is 1,530. So once again, that's a debit to warranty expense and a credit to estimated warranty liability. So when you're doing your adjusting entry for your warranty expense, note here it's debit to warranty expense, credit to estimated warranty liability. And then when you're doing the replacement, it's a debit to estimated warranty liability and a credit to merchandise inventory, or it's a credit to salaries payable if it was just labor that worked on it, or it could just be parts. It depends on what they did to, adjust the warranty. So then these are just more examples of the same, just more practice, but you can use those above to help you out. This was from Chapter 7, Accounting for Uncollectible Accounts. Similar concept to warranties. We know that a portion of our credit sales or a portion of our accounts receivable is going to be uncollectible. And so because we can reasonably estimate how much that's going to be based on past history of the company, and because it's a significant amount, we have to use what's called the allowance method. And so this first, I think I took these off for period 5 and 7, so disregard these 2 true and false here. This is the multiple choice here. A company estimates 10,200 of its receivables will be uncollectible. So of all their accounts receivables, they ran the numbers, and based off past history, they don't expect to receive 10,200. However, this allowance for doubtful accounts account, is a contra asset account. It has a credit balance. It subtracts from the accounts receivable to get the net value of accounts receivable after subtracting allowance for doubtful accounts. So once again, it has a credit balance, and it rolls over from period to period. And so sometimes we have some left over. Like in this case, we start with $1,300 already in there, and sometimes we start in the hole because maybe more people didn't pay us than we expected. But in this case, we collected more than we thought, so we carried over a $1,300 credit balance. And so because we only have to get to 10,200 and we start at $1,300, we just have to account for the difference between those two. And the journal entry, that adjusting journal entry, is a debit to bad debts expense for $8,900, and then a credit to allowance for doubtful accounts for $8,900. Number 2, similar question, just different format. $100,000 in accounts receivable. They tell us that uncollectibles are going to be 4%. So uncollectibles are 4,000. We start with a credit balance of 2,000. So how much should be debited to bad debts expense? Just that $2,000. 3, a company estimates bad debts as 1.56% of credit sales. So you would just take 525,000 times 1.6. And the percent of credit sales method does not account for the previous allowance method. So if you notice that's not there, it's because of that. And then this is how you journalize when you write off the account. So we were filling it up by crediting allowance for doubtful accounts, and then we find out someone's not going to pay us, we debit allowance for doubtful accounts and credit accounts receivable. Here's just some more journal entry examples. this, I'll just go through this last one here. This is when someone pays us after we had written them off. So on February 12th, we assume or we are made aware that B. Hughes is not going to pay their $1,200. Then a few months later, that changes and that company does pay in full. And so what you first have to do is you have to undo what you did on the write-off. So you have to debit accounts receivable and credit allowance for doubtful accounts to undo what you did up here. And then you close it out just like you would any other accounts receivable with a debit to cash and a credit to accounts receivable. Two more quick sections here. This is contingent liability cases. These are potential pending losses of money that are in the company's future, but you are uncertain of you're uncertain of the amount possibly, and you're also uncertain of whether or not that money will be lost or not based on a pending government decision or based on a pending lawsuit, or there could be several other examples. In this first one here, case one, Brighton Motors is being sued by a former engineer for wrongful demotion. Legal counsel says it's probable the company will lose with estimated damages at $250,000. So because it's probable and because the damages can be estimated, we would record the liability. So that would be A. And if you're, uncertain about any of this, there's a slide in the Chapter 9 slides that shows a chart of how this breaks down. But basically, since it's probable we're going to lose and we can't estimate, we have to list it as a line item on our balance sheet under liabilities as a contingent liability. Now, in case two, the loss, it is probable that we're going to lose, but in this instance, the amount can't be estimated. And so because it can't be estimated, you don't record the liability, but you do have to disclose it in the notes. And then case three is it's not probable, it's possible, and the amount is known, but since it's not probable, you can't record the liability, you only disclose it in the notes. So once again, it's only when it's probable that you're going to lose that money and that the amount can be estimated do you record the liability. Otherwise, you disclose it in the notes unless it's a remote possibility that you lose money. And if it's remote, you don't have to do anything. Last thing here is sales tax payable. As you know, when you go to any store and you purchase something to add tax on top, this is from the company's perspective, how they journalize for that. So this was on a $25,000 sale with $1,500 of sales tax put on top of it. So the company received $26,500. So that's obviously debit to cash, credit to sales, but the new account there is sales tax payable. So that company is just a custodian of that money until they pay the government those sales taxes. And so that's why it goes automatically into that liability account. So it's a credit to sales tax payable, and then when they pay the sales tax to the state, it's a debit to sales tax payable for $1,500 and a credit to cash for $1,500. That is it. Good luck. Email me with any questions.